Hello everyone, and welcome to our presentation on inheritance tax, or as we're going to use the letters all the way through it, IHT. Presented today is myself, Paul Howorth. I'm an independent financial advisor and I work for Menzies Wealth Management. And with me is my colleague Gemma, who's a tax manager from Menzies LLP. I hope you find this presentation informative. Although it provides an overview of inheritance tax, it's only with regard to UK inheritance tax. It's not really possible in a brief oversight to consider the position where people may have assets in more than one country, notwithstanding the fact that there are limited numbers of sort of tax treaties between the UK regarding inheritance tax. Some of you have already provided questions, and either ourselves or your usual Menzies contact will be in touch after the presentation. Any questions you might have today, if you can pop them into the question and answer, then we'll follow it up. The difficulty is it's such an immense subject that we could probably be here for quite a number of hours if we were doing questions and answers. Just to give you a background, UK's had a type of estate duty since 1694. And the actual modern concept of sort of inheritance tax was introduced in 1894, and that was to pay down the deficit. Just a little bit of interest is at the time that our deficit in 1894 was £4 million. It's now 2 trillion. And if it got up just by inflation over the last 100 years, it would now be 533 billion. So we're about 3/4 higher in deficit. So paying down the deficit and using inheritance tax to do it really hasn't been immensely helpful over the last 100 odd years. If we look at inheritance tax, generally it's really necessary to give something up to try and mitigate the effect. So it could be ownership of something, it could be control of how you deal with that item. It could be that you give up the fact that you're a low risk investor and you maybe invest in things that have a little bit higher risk. And it could be that you give up cash on a regular basis. And we'll come to cover off, because I've put there to fund insurance, and I'll cover that off a little bit later on in the slides. I'll just pass you over to my colleague Gemma, and she'll take you through the next couple of slides.
Hello everybody. Right, so when working out your inheritance tax liability, the first thing, which may seem fairly obvious, is to look at what you actually own and make sure you have realistic valuations for those assets. Lots of people think that the family home is exempt, for example, as it is for capital gains tax, but for inheritance tax it is firmly in the net along with everything else. We would suggest that you regularly review this as well, at least after major life events, but possibly every 5 years. Hopefully pensions and insurance policies, which we've put on the slide here, will be written in trust outside the estate, so there won't be any inheritance tax due. Paul's going to cover this in more detail later in the presentation. The most important thing I often find is don't forget paintings, jewellery, any sort of smaller items that may have second-hand value. Lots of people ask what happens if they're just not declared, and that's kind of down to the level of comfort of the executors that will be dealing with your estate. They will have to sign to say they've included everything. So yes, things may disappear, but it's not really recommended. If we move on to the next slide, again, you can see that I've said about being realistic when valuing your assets. I've come across clients in circumstances where they have both underestimated and overestimated their net worth, which can lead to nasty surprises down the line when it may be too late to do anything. It's also important to take professional guidance. If you're doing some sort of planning opportunity, then Zoopla's value for properties may be absolutely fine. But when it actually comes to probate, then it's important to get formal valuations at death, otherwise that can cause problems. If we look at the first step, really, is making sure you have a will. Inheritance tax is payable according to what your will says, and if you do have a will, well done, because lots of people that I come across don't, and there may be a variety of reasons for that. But the stark truth is that without a will, you're subject to the intestacy rules. And I don't know whether people are aware of those, but basically, if you're married with children, then the first £270,000 of the estate will go to your spouse, and everything else is split equally between your spouse and those children. But what happens if your children are very young? What happens if you've never married your partner? Or you've been married more than once and you've got more than one family to take care of? Basically, having a will gives you a lot more flexibility and control over where your assets are going to go. And again, once this is drawn up, rules change, legislation changes, so it's important to review this regularly too. These days, the sort of standard for a will for a married couple is that they will leave everything to their spouse unless they have predeceased them, in which case things are passed on to the children. So in these circumstances, there would be no inheritance tax on the first death amongst the couple, and everything, there would be no, and the inheritance tax charge would fall on the second death. So we're going to move on to have a look at the sort of gifts which are exempt from inheritance tax, just because these are always useful and need to be taken into account when calculating your potential liability. So you can make an annual gift of £3,000 to anyone you like, and that is immediately exempt to inheritance tax. Unfortunately, this rate was set in 1984, so it's not really that current. It has stayed at £3,000 for many years. If you haven't used your £3,000 exemption for last tax year, you could go back 1 year to take advantage of it this year. So basically at this point, you could make an exempt gift of £6,000. Moving on to marriage, if you know somebody that is planning to get married, it's possible to make exempt gifts to them. So if it's your child, it's £5,000. If it's a grandchild, great-grandchild, it's £2,000. And if it's to anyone else, such as a niece and nephew, maybe a godchild, it's £1,000. We've put the other exemption in here, which basically is the small gifts exemption. You can give £250 away to as many people as you would like per tax year, but not in conjunction with the other exemptions. So effectively, if you knew 1 million people that you wanted to give £250 to, you could completely exempt to inheritance tax, but in practice that's very unlikely. We've next put gifts out of income, and we're going to come back and discuss that one in a little bit more detail later on. And then the last bit on the slide is a potentially exempt transfer, or PET, you may hear the term, which basically says that you can give anything away to any individual, but this gift will become chargeable to inheritance tax if you die within 7 years, and it is exact 7 years from the date of the gift. Then you have to come back and look at it for inheritance tax purposes. And usually it will reduce your available nil rate band, which we're going to discuss in more detail in a second, and could even be chargeable on death, so that you would have to go back and find some more tax to pay on that asset. Only one quick word of warning is that if you want to give away assets rather than cash, you need to watch your capital gains tax position, because the two come hand in hand. So on this slide, we've covered exemptions. When you're making a gift from one UK spouse to another UK spouse, then as we've touched on already, it's 100% exempt to inheritance tax, which is why we don't get the charge until the death between the second of husband and wife. I'm going to mention business property relief and agricultural property relief here very briefly, as Paul will cover those later in the presentation. But basically, on a business asset, such as a share in a partnership or shares in a trading company, there is 100% exemption in the right circumstances. And there can also be for farmland, farm buildings, etc. But it does very much depend on the position for the people that are making the disposal or on death. And then lastly, for the charitably minded amongst you, there is 100% relief on any gift made to charity. I mean, and that's on death or at any other stage through your life. So moving on to the nil rate band, or NRB, as you may have come across this term before. Basically, if an individual is subject to UK inheritance tax, then they are entitled to this nil rate band, which is currently £325,000. Again, that's been set for some time and won't be increasing for at least another 5 years. It used to be, under the old rules, that on the first death between husband and wife, if everything was transferred to the spouse, taking advantage of that exemption, the nil rate band was wasted. So they brought in some rules about 10, 12 years ago to make that nil rate band transferable between spouses, so that now on the second death, the second spouse is entitled to a nil rate band of £650,000, less gifts, etc. And about 5 years ago, they brought in the residential nil rate band, which says that if you are passing on a property, doesn't necessarily need to be your house or the proceeds from the sale of your property, to your children or further issue, that you can have another £175,000 that is exempt. And this is transferable between husband and wife in the same way as the basic nil rate band. It is tapered for estates over £2 million, so it's important to make sure that whether it's going to be available or not. But hopefully you can sort of see from those numbers that the Chancellor at one point said that all households worth less than £1 million would be taken out of inheritance tax, and you sort of get there with the doubled up nil rate band of 650,000 plus the doubled up residential nil rate band of 350,000. That does give you your £1 million exemption in the right circumstances. And obviously your nil rate band, as we've already touched on, will be reduced by any gifts that you've made in the 7 years prior to death, so it may not be fully available. So hopefully, once we've gone over all of this, the value of your estate, less the gifts that you've made that aren't covered by exemption, less the actual exemptions, less the nil rate bands available to you, then you can have a go at calculating your inheritance tax exposure. The tax will be due at 40%, or possibly in some circumstances 36%, but we'll touch on that later. So then the answer is really, what can you do about that liability that you've calculated? So it might be that you want to keep it and you don't worry about the tax that becomes due. After all, it will be your executors that will have that to think about rather than yourself. It might be that you want to insure against the liability. It might be that you literally want to make sure you spend everything that you've accumulated over your lifetime, and then you won't have to worry about the inheritance tax due. And lastly, you could have a look at some sort of succession planning, and we're going to start talking about some planning possibilities now. I'm going to pass you over to Paul, who's going to start considering those on the next slide.
Okay, thanks very much, Gemma. Yeah, there are. This leads to some planning possibilities, things that you can do which will mitigate the inheritance tax that you may be payable. And just to give you sort of a few very brief points, you can insure a liability, which I will cover off. All of these points, sorry, I'll cover off in the next couple of slides. You can insure it. You can put it into a trust to give control of it for you, maybe, but actually move it away from your estate. You can use what's known as a family investment company, which have become more popular in the last few years. And there's a thing that I would call other, which is using things that can maybe give you an exemption, which are sort of less usual, but obviously can be utilised. If you're looking at insurance, then there's sort of two times that you might insure. One would be if you made a gift, and you're worried about the fact that if you die within 7 years, there may be an issue, because obviously the gift might well either form part of the nil rate band, so you get taxed a little bit further up, or it might actually be that you know, you've made that gift and you just don't want to have the liability fall on the estate full stop. And the other one would be if you just simply have not made any gifts, but you have an estate that's in excess of the exemptions, and therefore you're going to end up with a tax bill. basically, on a couple, generally, if you're looking at the way these types of policies work, basically, you would do what's called a second death policy. All that means is that when the first person dies, assuming that the estate is transferred over to the husband or the wife, then there is no liability, because there isn't an issue with regard to husband-wife transfer in almost all circumstances, depending on where someone's born. Basically, you would want it to be paid out when you get to the final person passing away. And obviously, if we're looking at it, this sort of life policy is written into a trust, because you wouldn't want to do is see it come back into the estate, because obviously normally a life policy comes back to you, but you're deceased and therefore it will be in the estate. So actually you write into a trust, the money comes out, it goes into the trust, which then pays the money to the family to be able to pay the inheritance taxes. It is a quite good solution, because effectively there's an exemption straight away, because if you've got cover in place, then it's going to pay out. But the real issues are generally the people who start to think very seriously about inheritance tax planning tends to be people who are older, and therefore you've got to look at whether your age or your health allows you to actually continue to pay. The other thing is that there's always a difficulty with regard to the cost, because if the liability is very large, and I've come across one recently which was just under £2,000 a month for the cost, but it was quite a large estate, the amount being covered, then obviously that can be a difficulty, particularly where maybe someone who earns more passes away earlier, because that then might mean that the person's then struggling to pay the bill. But of course they can pay it from their their savings if they want to. And it's also a bit of a difficulty because it's a moving feast, and that's because on day one you've worked out your calculations of exactly how much insurance that you need, but unfortunately both the allowances and exemptions change, and the value of your estate changes, because if you think about it, your house goes up in value, your investments may fall or may rise, and all of that then causes a problem. Obviously, if it rises, you're going to want to take more insurance out. And the trouble is, if now you're 87, this is problematic, because you may well have an inability to buy more insurance. You'll still have the original insurance if it's underwritten, but you just can't keep on moving up. So it does have its problems. Obviously, the next subject is trust. What I'm going to do is pass back over to Gemma and let her go through those with you. Sorry.
There we go. Okay, so thank you very much, Paul. The first, oh, sorry, could we go back one slide, please? The first thing I would say about trusts is that it's important to take advice on any sort of trust arrangement. I come across people that have tried to set them up themselves and not quite achieved what they were hoping to do so. There are three main types of trusts that you're likely to have come across. The first being a discretionary trust, which basically works that you move the assets out of your estate as a gift to the trust. It's what's called a chargeable lifetime transfer. So there is the possibility of tax at 20% in excess of your available nil rate band. But if you survive 7 years from that point, then there's no further inheritance tax, and the growth in your assets will be outside of your estate. The beneficiaries of a discretionary trust can be drawn quite widely. It may be people that have not yet been born, future grandchildren, great-grandchildren, etc. An interest in possession trust or a life tenant trust used to be very, very popular, but unfortunately the rules have changed now so that they can only be set up on death. But basically, if you had your first spouse to die, you transfer their estate to an interest in possession trust. It effectively ring fences the underlying capital, which might be passed to children of a previous marriage or help to protect from care home fees. But the second spouse will have any income generated from that capital or the right to live in the family house until their death. But it just helps to save the underlying capital for future people. And then the last type of trust that you may have come across is the bear trust, usually found these days where people are passing cash or assets, some sort of investment, to grandchildren who are under the age of 18. perhaps to be used to pay their school fees. And that can be quite helpful in some ways. The parents of the child will administer it. The only thing you need to consider is that as soon as that child turns 18, it legally belongs to them. So you may not be wanting to put large sums of cash into the hands of somebody who is still quite young, potentially. Trusts used to be more tax efficient than they are these days. HM Revenue and Customs have waged a bit of a war against them in the last 20 years, but they are really great if you're looking to protect your assets or you want to maintain some control. If you want to give away something, if you appoint yourself as a trustee of the trust, then you're still looking after it on a day-to-day basis. It can be quite useful, for example, if you had serial marriages. I came across one family where they had moved the family company into a trust, the parents, purely because their son was in the process of getting his third divorce and already had wife number 4 lined up, and they could have been passing over considerable value to the successive wives if they hadn't undertaken that protection element. There are pitfalls with trusts. For discretionary trusts and for interest in possession trusts, we try to set one up in a lifetime these days. They both are subject to 10-year charges to inheritance tax and exit charges, although it may be possible to mitigate these in some places. For a discretionary trust, any income that it receives is taxable at the highest rate, so 45% income tax, 38.1% on dividends. Although if the beneficiaries are minor grandchildren with no other income, then it may be possible for them to reclaim the tax paid by the trust, which makes it a little more efficient. So basically, to sum up on trusts, they are really useful in the right circumstances, but it's important to take advice. Nowadays, we find that people are potentially looking at different types of structures, perhaps a company, which they'll be more familiar with from their working life. But how do they make that work for them? And the answer is some sort of family investment company. And I'm going to pass you back to Paul, who's going to talk about those in more detail.
Thanks very much, Gemma. Generally, family investment companies, they're frequently used as an alternative to setting up a trust. And all it is a sort of private limited company with a set of bespoke rules. And really the idea of that is to try and prevent the shares being transferred outside of the family, and also to lay out in the event of a dispute how the company will be valued. Generally, the shareholders will be family members, and potentially it could be a family trust as well. Quite often there's a use of what's commonly called alphabet shares. Now, all alphabet shares is shares with different classes, so A, B, C, D, E. And what you do is each of those may have different levels of control of the company's decisions. They'll have different rights to dividends and different rights to the capital value within the company. So you're able to sort of divide up who has control and who is allowed to get income or capital from the company by making sure you give them the right alphabet shares. And it allows the gifts to children or other family members to be planned in a very carefully controlled way for timing and for looking for the best value and tax treatment that someone can possibly do. Generally, they're founded by a loan from, for example, parents, and they also subscribe for the shares. And what it means is that obviously that money can be used to make money. So it will be invested typically, and it will make money over time. But obviously, as it was originally a loan, they won't be taking back a dividend, which is particularly taxable. They will be taking back the repayment of the loan they've already put in. Therefore, it's not subject to income tax. Obviously, it's not a totally free lunch. Family investment companies are subject to corporation tax on the income received. Though it's likely to be at a lower rate than personal marginal income tax, assuming the people involved are likely to be higher rate taxpayers. Obviously, one little issue on that is that there are some increases, obviously coming through with regard to dividends anyway. That's just a sort of point, obviously, with regard to the national insurance. Advantages is most dividends that are received by a UK company are exempt from corporation tax, and allows the growth and roll up of the investments with the tax deferred until a later date. The other thing is, for parents, if you have a trust, you have quite onerous duties, and you have to be quite careful about what you do with regard to being a trustee and how much risk you take. But as a director of a company, you can take a lot more risk, because ultimately you're in control of the company's destiny, and you're able to do a very adventurous, if you want to, investment strategy, and that will be more than maybe a trustee would be comfortable with. Disadvantage is potential for double taxation, because obviously you've got corporation tax on the income that comes through, and then you've got income tax due to the shareholder when you finally pay the money out. Now, there are ways to manage that through the investments that the company may hold, and when you time your distributions to people. So it could be where you will pay out some dividends to people when maybe they're at university and maybe a non-taxpayer, as an example, and obviously that could mean that they're going to be at a lower rate. Obviously, the next little thing we're going to move on to is going to be with Gemma again, and that's about the other parts of other, with a little bit from me at the end.
Thank you, Paul. Okay, so I just wanted to come back and cover off a couple of points for you all. So if we move on to the next slide. Apologies. So making gifts out of normal income. We touched on that earlier, that it is a gift exemption available, and it is very useful. Sorry. So basically, at the time you make that gift, there is no 7-year rule. It's immediately exempt from inheritance tax, and the amount that you give away could be unlimited in the right circumstances. So it's very valuable. So there are 3 important rules to follow, which is basically that these gifts must be made out of income on an annual basis. They must form part of your normal expenditure and are paid out on a regular basis as part of a pattern. And the payments made should not have any impact on your standard of living. So effectively, if you had somebody with pension income of, say, £70,000 a year, their expenses are only £20,000. They've no longer got a mortgage to pay. They don't go out and about as much as they might have done previously. Then effectively, they could look to give away £50,000 a year. It's important to keep details, because when it comes to the probate process, then you have to provide records of both the income and expenses, and it's much easier to do that at the time rather than looking back historically. Effectively, you need 3 payments to establish your pattern, but if it's important to keep records, if you show your intention and unfortunately the donor dies before that 3rd gift can be made, then HM Revenue and Customs may still allow the previous gifts, because they can see what you were trying to achieve. The other thing that I wanted to just go over again in the short period is the reduced rate of inheritance tax. Again, for those that are charitably minded amongst you, if you were to give away 10% of your net estate to charity, then that actually reduces the level of inheritance tax paid on the balance of the estate. So on an estate of £2 million, you leave £200,000 to charity, you will only pay tax at 36% on the balance of the estate. Sometimes I come across clients who want to give away a sum of money, maybe not as much as 10%, but in actual fact, if they're giving away at least 4% of their estate already, then through a quirk of the numbers, you can increase your gift to charity, and that will actually come out of money that would have previously been paid to HM Revenue and Customs. The family will still receive the same net estate at the end of the day. I'm going to pass you back to Paul now to have a look at agricultural property relief and business property relief and the planning opportunities that come from them.
Thanks very much, Gemma. Yeah, basically, you've got agricultural property relief. It applies for agricultural land, woodland, grazing land, agricultural buildings. As I've put there, which I'll come to in a second, you've got to be very careful regarding the farmhouse or other buildings, particularly where these days many farmers and people who have agricultural land have diversified into, say, holiday lets and all sorts of other things, which obviously may have different treatment. It's subject to a period of ownership test, which is 2 years ownership or owned for 7 years and occupied by someone else, maybe leased out. You get 100% relief where it is farmed by the owner or let to a third party under a tenancy after 1995. And if it was let with a tenancy commenced before that date, you get vacant possession within 12 months. Otherwise, you only get 50% of the property relieved. One particular point is you've got to be very careful on the farmhouse, and it's only agricultural property relief is only available on the agricultural value of the property, which is often lower than the market value. In order to qualify for agricultural property relief, your cottages, buildings or whatever must be of a character appropriate to the property. So you could say that Blenheim Palace is a farmhouse, but I have a real suspicion that it's very unlikely they are going to give you relief against that. And really it comes down to whether an educated layman would view the property as a farm or a house which has got a lot of land, which really, if we think about Blenheim Palace, that's where that one sits. Just moving on from that, we've got a business property relief. So agricultural is just to do with agricultural land. Business property relief is basically for business assets. It was introduced quite a long time ago now, 1976, and it's been, the sort of coverage has been expanding all the time. You need to have 2 years ownership to qualify. It applies to all types of businesses. But if, for example, you have a building you let your business use and you've got control of it and you use it, say, for example, in a business which you're a partner, then your business property relief is only at 50%. So effectively, it's not owned by the business, it's owned by you, but used by the business. Now, as it says there, there's quite a useful thing. Certain investments can provide BPR, and that can be for people who are non-business owners. And this has been quite a big change in the last few years. I'm just going to go through how that sort of works. Next slide, please. Thank you. There's sort of two types of investments which have been created by people in the investment community, and they've used the rules and they've been quite innovative, but obviously they all fit within how those rules are structured. So the first one is a provider controlled company. So that might be that a particular company was set up by an investment provider, and they will form a number of businesses. And that might be, they're looking generally for things that have predictable returns. So historically, it's been things like solar panels with a government feed-in tariff. It might be fibre broadband, because obviously that gives a real nice ongoing income. It might be, for example, lending to the property sector with relatively low loan to values. And all of those, as far as the providers are concerned, offer a predictable return. And typically they may offer an interest rate. So they may say, it's a target return, how they would describe it. And they might say, for example, it's 3%. So all that means is when you hold the investment, they will provide you with 3% return. That is not a guaranteed return. It may turn out that they can't afford to pay that. The only thing I would say is many of them do pay it. And that's normally after the costs each year. And in many cases, they won't take any of their costs if they don't hit the target return. So effectively, they've got to hit the cost to make their money. The other option is using AIM-listed company portfolios. So the AIM is the junior stock market of the UK. A lot of people sort of think, oh, you know, do I know anyone that's listed on there? And there's quite a number of well-known companies on there. So, for example, Nichols PLC, which is the people who make Vimto and Sunkist. You might have heard of Boohoo. Might have heard of Young's the Brewers, which is a very well-known London brewery company. I would say as seen on screen, but obviously you've probably seen recently their share price slid a little because they've not done quite so well. Gemma is about 900 listed on the market, and the investment providers will create a portfolio of 30 or 40 companies. And the reason why it's sometimes a good idea when you have a provider making these types of portfolios rather than investing yourself is, one, for a spread of risk, And the other thing is because small companies have very few people following them in great detail. So analysts don't necessarily provide you with free reports, which you might be able to access with the main market. And therefore, it's quite a difficult thing if you're not really good in investments to understand what's going on. The other thing is that the AIM listed option can be placed in an ISA, or of course, a cash ISA or existing stocks and shares ISA can be transferred across into an AIM investment. Now that gives a lot of opportunity for restructuring finances as people become older, maybe where they were generating income or growth because they wanted to spend a lot when they were in their earlier years, and now they don't spend very much at all. In some ways, the AIM is a bit of a nirvana investment. It's got no tax on, if it's inside an ISA, it's got no tax on growth, it's got no tax on income, and no tax after death once you've held it 2 years. But you've got to remember, it is a higher risk investment. So these are not companies that you would put your money you were going to use in a year's time, because unfortunately it might not work out. Next slide, please. Just to give you a summary about why business property relief investments can be quite useful. It means that the money remains available to the person because it's still held in their name. So it's not transferred away, it's just in an exempt investment. And even on a provider controlled company, it would hopefully provide more than a bank account can. But obviously, you've got to remember that that is not a guarantee, because they're target returns. They're not a guaranteed return. AIM growth can, of course, be substantial, but of course, shares can go up and down depending on what goes on in the outside world. One of the other things it's quite good for is the fact that if you're acting under a lasting power of attorney, then unfortunately you are not allowed to make substantial gifts. So you're not allowed to give the money away and reduce the estate. But actually, if you've got the money held inside a BPR portfolio, then actually it's never left the estate, but actually it's become exempt. And I'll go through actually a case that I dealt with a little while ago and actually show you how that works. Both are considered riskier because of liquidity issues, and they're smaller nature. So this is not a risk-free lunch. There are significant advantages, but also significant disadvantages. And you've got to remember that if you're over the £2 million mark, as Gemma said earlier on, you may lose the residential nil rate band. It's because the business property is exempt, but not excluded. Quickly on to one more slide, which is regard to pensions, because pensions are obviously now very, very useful. Generally on pensions, there's no inheritance tax on assets within pension funds in most circumstances. And in fact, if someone passes away with a pension fund under the age of 75, it's actually free of tax on withdrawals to the next person. Basically, if you're over the 75, it's taxed at the rate of tax when the income or capital withdrawn is added to the person's income. However, there are some times where there could be inheritance tax. One would be if you were in poor health and you made transfers to in benefits to another scheme in the 2 years, or pay contributions, or putting any of these policies into trust. Basically, you did that in the last 2 years when you were in ill health. Or it could also be where there are payments that continue after death, but they're not subject to discretion. So, for example, you've got an annuity, and it basically is something where you have said you wanted to go to someone. So it's generally not including the estate. You can nominate your beneficiaries on it, which is quite useful. They don't have to be the same as your will. It's up to you. And obviously, as I said, tax-free withdrawals on death before age 75. Obviously, that's not a great tax planning move, trying to die just before your 75th birthday. I would suggest it's probably not the best thing. Next slide, please. Okay. Obviously, a couple of downsides. Maximum limits been frozen for 5 years, and limits 1,073,100. That means more people are going to be caught for basically money that they now can't put into pension because they would actually pay a tax charge if they go above that limit. Some people have got different limits if they took some actions in the past when the rules changed, and it's a little bit too complex to go into all of the issues there, but sufficient to say that, you know, if you took some actions in the past, you may actually have a higher limit than 1,073,000. Inheritors' own allowances are separate to those that they inherit. So it's possible that someone inherits 1,073,000 and actually they have 1,073,000 themselves. That's entirely possible, and it's within the rules, and it's absolutely fine. The other thing you need to be very careful on is the scheme rules dictate what's allowed, and you need to understand what they say, don't assume. Some very old pension schemes will actually pay the money to the estate, so it goes to the estate. It's not can't be changed. That's how the scheme is set up. It could be for some very old pension schemes that there's no return of funds at all, and that's horrendous. And obviously, you need to understand that that's the case. So just be very careful. Basically check your old schemes. That's right. Thank you. Try and give you a couple of quick case studies. These are real people, albeit they're over the last 10 odd years. An example of this one: Mrs. X was in a care home. Weirdly, her costs were being paid under NHS continuing care, despite the fact that she had quite a lot of money. And it's a bit of a sort of dark art. It's not the same as local authority, and my experience in this case was that the NHS didn't really push very hard to stop that, whereas I have no doubt if the local authority had been in charge, they would have done so. Obviously, because the NHS is paying the care fees, the estate is growing because basically nothing's going out. She had very limited costs for herself. The assets were well over the inheritance tax limit, so it was nil rate band plus about 500,000. And the other thing was the son, because the lady was had the early stage of dementia, the son was dealing with the money under a lasting power of attorney. Remember what I said earlier? He can't give the money away. He's not allowed to. He can make modest gifts only. And another strange quirk was purely that there wasn't any double nil rate ban, because actually it's a second marriage and Mr. transferred his own exemption away to someone else. So she didn't have 2325, she only had one. Basically, we constructed it where she'd use a business property relief investment. She received 3% per annum after annual costs. She was in the fund for about 4.5 years. She died at 91.5 years old. It saved around 200,000 plus the 3% return on the investment that she received. So obviously it worked very well. And the family received all that money, and it was divided up between the son and the grandchildren. Another option is another option was a client who sold a business and received 500,000 in proceeds. They wanted to spend the capital they received. Sorry, I meant to say I meant to say the capital they received for living expenses, but they were unlikely to need more than that original figure because of their age. They were 78 when they sold the business. They really didn't want any of the investment growth that might come back from that 500,000, but they wanted the capital itself to enjoy their retirement. And then obviously we invested that for them to allow investment growth. The lady drew back 5% per year from the investment, and that was for her lovely lifestyle in retirement. And the fund growth, whatever it grew by, is actually in trust to her daughter. It's actually still running now. But basically, it's been running for 10 years. She can draw back that capital at any point she wants to, because obviously it's money that was a loan into the trust, and that's the most important thing. And the growth was outside the estate, but obviously the capital is always that lady's money, because that's why she can draw back the 5%. Next slide, please. Okay. And I always love this quote, which is, it's 35 years old. To some extent, things haven't changed. Roy Jenkins, who used to be the Chancellor of the Exchequer, said inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. And I'll hand back to Gemma to finish everything off.
Okay, so there should be a poll question coming up on everybody's screens. If you can indicate what areas you would like to find more out about, then we'll just leave you to have a look at that for a minute. Okay. Oh, very good. Yep. So people will be in touch to follow up with each and every person, depending on what they've asked for more information on, either myself or Paul or your regular Menzies contact. And if we move on to the next slide, then this is just basically to show that, to sum up, basically, these are the important things we think you should take away from today. Make sure you know what you own and how much it's worth. Make sure that you have a will so that you have control over where your assets will pass and that this is looked at regularly. Any sort of planning that you decide to undertake, make sure you keep records so that it's clear to everyone what you were intending. Don't leave your planning until you're quite elderly, when it may be too late to achieve a lot of what you could have done many years earlier. And come and talk to us if we can help in any way about what you want to happen. So thank you very much for listening today. Don't forget to put any questions in the Q&A if there's something that you'd like some more information on. And if we just move to the last slide, we've just got our disclaimer for today to remind you all that this is based on today's rates and allowances and does not constitute advice.
And apologies that we overran. He went well in practice. It was dead on, but unfortunately, the best laid plans off going right.
Thank you very much, everyone.
Thank you.